Something unprecedented is happening in Toronto right now, and the people in charge are starting to sweat. Condo towers that were once symbols of prosperity and growth are now standing half-empty, unsold units stacking up like a warning sign that nobody wants to read. The mayor's office is scrambling, developers are losing sleep, and thousands of investors who thought they were making the smartest decision of their lives are now watching their financial futures crumble in real time. What you're about to hear isn't just another doom and gloom story about real estate. This is the inside look at how one of North America's hottest housing markets went from unstoppable to unrecognizable, seemingly overnight. If you haven't already, make sure you hit that subscribe button and turn on notifications because we're covering stories like this every single week, breaking down what's really happening in markets that affect your money, your future, and your decisions. Trust me, you don't want to miss what's coming next. Let's start with the numbers because they tell a story that words alone cannot capture. In the first quarter of this year, new condo sales in Toronto dropped to levels not seen in decades. We're talking about a decline so severe that industry insiders are calling it a generational low. To put this in perspective, during the peak years, developers were selling thousands of units per month. Buyers were lining up, sometimes camping outside sales offices, just to get their hands on a pre-construction unit. Fast forward to today, and some projects are reporting single-digit sales over entire quarters. Single digits. For buildings that cost hundreds of millions of dollars to construct. The average price per square foot, which was once climbing at a pace that seemed almost comical, has flatlined and, in many cases, started to reverse. Listings are sitting on the market for months instead of days. Price reductions that would have been unthinkable just 2 years ago are now becoming standard practice. And here's the thing that's really getting people's attention. It's not just the resale market that's struggling. The pre-construction market, which has always been the canary in the coal mine for Toronto real estate, has essentially ground to a halt. Now, you might be wondering, how did we get here? How did a city that seemed immune to the laws of real estate gravity suddenly find itself in free fall? The answer is a perfect storm of factors, each one devastating on its own. But combined, they've created a situation that nobody saw coming. Let's talk about interest rates first, because this is where the bleeding really started. When the Bank of Canada began its aggressive rate hiking campaign to combat inflation, the effects rippled through the housing market like a shockwave. Buyers who were pre-approved for mortgages suddenly found themselves unable to qualify. Investors who had been leveraging cheap debt to build their portfolios watched their carrying costs double and, in some cases, triple. The math that made sense at 2% interest rates became financial suicide at 5 or 6%. But here's what makes Toronto's situation particularly brutal. Unlike single-family homes, condos come with additional monthly costs that can be substantial. We're talking about maintenance fees that have been skyrocketing, property taxes that keep climbing, and special assessments that seem to pop up without warning. When you add all of these costs to a mortgage payment that's already stretched buyers to their limits, you start to understand why so many people have simply walked away from the market entirely. And walking away is exactly what's happening. Assignment sales, which is when a buyer sells their contract before the building is completed, have absolutely exploded. But here's the problem. There are far more people trying to sell their assignments than there are buyers willing to take them on. This has created a cascade effect where prices are being slashed just to find any buyer at all. Some investors are taking losses of $100,000 or more just to get out of deals they can no longer afford to close. The mayor's office has been watching all of this unfold with growing alarm. Why? Because Toronto's entire development model has been built on the assumption that the condo machine would keep running forever. The city collects massive development charges on every new unit. Property taxes from these towers fund essential services. Construction jobs support tens of thousands of families. When the condo market sneezes, Toronto catches pneumonia. Recent reports indicate that multiple high-profile projects have been delayed indefinitely or canceled outright. We're not talking about small boutique buildings here. We're talking about towers that were supposed to add thousands of units to the city's housing stock. Developers are doing the math and realizing that it no longer makes sense to build when construction costs are at all-time highs, but the prices buyers are willing to pay are falling. The economics simply don't work anymore. This has created what economists call a death spiral in certain segments of the market. Fewer sales mean less revenue for developers. Less revenue means they can't start new projects. Fewer new projects mean fewer construction jobs. Fewer jobs mean less money circulating in the local economy. Less money in the economy means even fewer people who can afford to buy condos. And round it goes. The rental market tells another part of this story. For years, many condo investors justified their purchases by saying that even if the condo didn't appreciate in value as quickly as expected, they could always rent it out. The rental income would cover their costs and eventually lead to profit. But the rental market has changed too. An unprecedented number of purpose-built rentals are coming online, adding competition. At the same time, many of those investor-owned condos that were supposed to be sold are now being reluctantly converted to rentals, flooding the market with supply. Rents that were climbing at 10 or 15% annually have started to stabilize, and in some areas they're actually declining. Imagine being an investor who bought a pre-construction condo 3 years ago at the peak of the market. You paid a premium price, locked in before interest rates started climbing, and assumed that by the time your building was completed, values would be even higher. Instead, your building is about to register, the value of your unit is lower than what you paid, interest rates have doubled your expected mortgage payment, and the rent you can charge won't come close to covering your costs. This is the nightmare scenario that thousands of Toronto investors are living through right now. The human stories behind these statistics are heartbreaking. Young couples who saved for years to put together a down payment, only to watch their investment lose value before they even moved in. Immigrants who pooled family resources to buy into the Canadian dream, now facing the prospect of losing everything. Retirees who were counting on their investment properties to fund their golden years, suddenly scrambling to figure out how to cover the shortfall. And it's not just individual buyers who are feeling the pain. The developers themselves are in crisis mode. Several major development companies have seen their stock prices crater. Bond ratings have been downgraded. Lines of credit that were once easily extended are now being pulled. There are whispers in the industry about which companies might not survive if conditions don't improve quickly. The city government is in an impossible position. On one hand, they desperately need development to continue because the fees and taxes fund so much of what they do. On the other hand, they've been under enormous pressure to address housing affordability, which means they can't be seen as too friendly to developers. The mayor has been trying to walk this tightrope, making public statements about supporting the housing market, while also pushing for policies that some say are making the situation worse. One particularly contentious issue is the proposed changes to development charges and fees. Developers have been arguing for months that these additional costs are making projects unviable. They've presented detailed financial models showing that in the current environment, building new condos simply doesn't make economic sense when you factor in all the fees the city requires. The city's response has been that these fees are necessary to fund infrastructure and services. It's a standoff, and while politicians debate, projects remain on hold. There's also the investor exit to consider. For years, a significant percentage of Toronto condo sales were to investors rather than end users. Some estimates suggest that investors made up 40 to 50% of the pre-construction market at its peak. These investors, many of them from overseas or using the properties purely as financial instruments, provided crucial fuel for the development machine. When they started pulling back, the impact was immediate and devastating. International buyers who were once a significant force in the market have largely disappeared. Combination of foreign buyer taxes, stricter mortgage regulations, and better opportunities in other markets has pushed them elsewhere. Local investors, meanwhile, are dealing with negative cash flow situations that are forcing them to sell. The buyer pool has shrunk dramatically, and there's no indication that it's going to recover anytime soon. What makes this situation particularly concerning is that Toronto was supposed to be different. The city's boosters have long argued that strong population growth, limited land supply, and consistent immigration would always support demand. And while those fundamentals haven't changed, they haven't been enough to overcome the headwinds the market is facing. It turns out that even cities with strong fundamentals can't defy gravity when interest rates rise quickly enough. The construction industry is already feeling the effects. Job sites that were supposed to be buzzing with activity are quiet. Cranes that were supposed to be rising are sitting idle. Skilled tradespeople who were in high demand just a couple of years ago are now finding themselves with less work. This has ripple effects throughout the economy, affecting everything from material suppliers to restaurants that cater to construction workers. Looking at the broader picture, what's happening in Toronto isn't entirely unique. Cities around the world that experienced similar real estate booms are now facing similar challenges. But Toronto's situation is particularly acute because the boom was so pronounced and lasted so long. The further you climb, the harder you fall, as they say. The question everyone is asking now is, what happens next? There are several possible scenarios, and none of them are particularly comfortable for the people currently holding Toronto condos. The optimistic view is that interest rates will eventually come down, affordability will improve, and buyers will return to the market. This is certainly possible, especially if inflation continues to moderate, and the central bank begins cutting rates. Some analysts are predicting that we could see meaningful rate relief within the next year or two. If that happens, the pent-up demand that's been building on the sidelines could come flooding back into the market. The pessimistic view is that we're in for a prolonged correction. Years of excessive building, speculation, and price appreciation have created a bubble that's now deflating. In this scenario, prices could continue falling for several more years before finding a floor. Some of the most bearish analysts are predicting drops of 25 to 30% from peak levels before the market stabilizes. Then there's the wild card scenario, where something unexpected shifts the equation entirely. This could be a major policy change, an economic shock, or a demographic shift that nobody saw coming. Real estate markets have a tendency to surprise people, and anyone who claims to know exactly what's going to happen is probably not being honest. For potential buyers, this moment presents both opportunities and risks. On the opportunity side, there are deals to be had that would have been unthinkable just a couple of years ago. Motivated sellers, desperate developers, and a general lack of competition mean that patient buyers with secure financing can negotiate aggressively. Some units are trading at prices not seen since before the pandemic. On the risk side, catching a falling knife is always dangerous. Buying today only to watch prices fall further tomorrow is a real possibility. The carrying costs of ownership remain high even if purchase prices are lower. And the psychological weight of owning an asset that continues to depreciate can be significant. For current owners, especially investors, the calculations are even more complex. Holding on through a downturn requires both financial resources and emotional fortitude. Many are being forced to sell, not because they want to, but because they literally cannot afford to hold any longer. Others are digging in, convinced that if they can just wait long enough, the market will recover and validate their original investment thesis. The rental investors face particularly tough decisions. Do you accept the negative cash flow and try to ride it out? Do you sell at a loss and stop the bleeding? Do you try to refinance and extend your runway? There are no easy answers, and the right choice depends entirely on individual circumstances. What should be clear to everyone watching this is that the Toronto condo market of the past is not coming back anytime soon. The conditions that created that market, ultra-low interest rates, speculative fervor, and an unlimited appetite for new construction, were extraordinary and likely temporary. What we're seeing now is a normalization, albeit a painful one. The mayor and city officials are going to have to adapt to this new reality. Development charges may need to be reconsidered if they want new construction to resume. Policies that discourage investors may need to be balanced against the reality that investor capital has been essential to getting buildings built, and expectations about the revenue stream from development will need to be adjusted downward. For the broader Toronto economy, the implications are significant. Real estate has been such a dominant force for so long that many other industries have become dependent on it. The lawyers, mortgage brokers, real estate agents, home stagers, moving companies, and countless other businesses that service the real estate industry are all going to feel the pinch. This could contribute to broader economic weakness if the slowdown persists. There are also social implications to consider. For years, the narrative has been that Toronto real estate was an unstoppable train, and that anyone who didn't get on board would be left behind forever. That narrative discouraged some people from pursuing other paths, convinced them to take on more risk than was prudent, and created a culture where property ownership became synonymous with success. The unwinding of that narrative will have psychological effects that extend beyond pure economics. Some observers are pointing out that this correction, painful as it is, might ultimately be healthy for the city. When prices become disconnected from underlying values and speculation replaces fundamental analysis, markets become fragile. A reset, while difficult, can create a more sustainable foundation for future growth. Young people who had given up on ever owning property in Toronto might find that their dreams are suddenly within reach again. But that's cold comfort for the people currently experiencing real losses. The theoretical benefits of a healthier market sometime in the future don't pay the bills today. They don't help the family that's facing foreclosure or the investor whose retirement plans have evaporated. As this situation continues to unfold, we'll be watching closely and bringing you the latest developments. The Toronto condo market has entered uncharted territory, and what happens next will have implications not just for the city, but for the broader Canadian economy. The decisions being made right now by policymakers, developers, and individual owners will shape the market for years to come. If you found this video informative and want to stay updated on what's happening in real estate markets that could affect your financial future, make sure you hit that like button. It really helps the channel and lets us know that you want more content like this. Drop a comment below telling us what you think is going to happen in Toronto. Are we at the bottom, or is there more pain ahead? And if you haven't already, subscribe to the channel so you never miss an update. We're covering stories that the mainstream media isn't telling you, breaking down complex situations into information you can actually use. Thanks for watching, and we'll see you in the next one.